Welcome to the Majestic Trader. Now, if you're serious about trading gold, really serious, then this video is for you. We're not talking about basic tips here. I'm going to show you how the pros, the institutional investors, trade gold. We're talking about the big players managing billions of dollars, and I'll give you a look inside how we do it, precisely, strategically, and with complete control. So let's dive into how you can trade gold like an institutional investor. Let me start by saying this: gold is not just a commodity. To institutions like ours, it's a strategic asset. Gold is a hedge against inflation, a safe haven during geopolitical tensions, and a tool to preserve value when markets turn south. It's not just about the glitter of gold bars, it's about the stability and security it brings to our portfolios. When the world gets volatile, we turn to gold. In fact, when markets start to shake, gold typically rallies. That's where we make our moves, anticipating those shifts well before the average trader even notices. Institutions have been using gold like this for decades. Central banks, sovereign wealth funds, and big financial institutions accumulate gold in uncertain times because it preserves purchasing power and provides diversification. It's not a temporary strategy, it's a long-term play that stood the test of time. Now, let's talk about how we actually make decisions. You see, we don't just buy gold on a whim. We base our moves on macroeconomic indicators, things like inflation, GDP growth, interest rates, and of course, geopolitical risks. When inflation rises, the real value of cash drops. Gold shines in those times. Institutions track CPI reports to spot those trends early and adjust our gold positions. That's one of the first things we look at when we anticipate a move in gold. Then there's the interest rate game. When central banks like the Fed lower interest rates, gold tends to do well. Why? Because with rates low, the opportunity cost of holding gold drops. So, institutions position ahead of these decisions, months ahead, often, as we monitor rate expectations. We're not reacting to the news, we're anticipating it. On top of that, when the world becomes unstable, whether it's a war, a financial crisis, or just political tensions, gold becomes our hedge. We know how to buy gold as insurance against those events, well before they blow up. Okay, so while macro analysis helps us set the broad direction, we need to fine-tune our entries and exits. And that's where technical analysis comes in. We're not using simple indicators like moving averages. We're talking about tools like volume profile and market depth, sophisticated techniques that give us insight into where big institutions are making their moves. With volume profile, we can see where large institutional buy and sell orders are sitting in the market. It shows us the price levels that are most important, the areas where big players are positioning themselves. We use that data to guide our decisions. These aren't just price levels, they're strategic points where the market is likely to turn. And then we look at market depth, the order book, showing us the volume of buy and sell orders at different price points. This tells us where the liquidity is, and helps us identify key levels where the market might shift. We follow the money. If there's a lot of buying at a certain price, you can bet we're positioning with it. Now, Fibonacci levels. They're not just some random lines on a chart. Fibonacci retracements and extensions help us identify key support and resistance zones. These are the areas where price is most likely to reverse. For institutional traders, it's not just about guessing, it's about using data-driven tools to make precise decisions. Let me be clear, risk management is the cornerstone of institutional trading. No matter how good a strategy is, we never risk more than 1 to 2% of our capital on any single trade. We're meticulous with position sizing, adjusting our trades as the market shifts. And this is how we protect ourselves from big losses. We don't just set arbitrary stop losses or take profits, we calculate them based on market volatility, technical analysis, and the overall market conditions. When we set a stop loss, it's because the market has told us where it's likely to turn. When we set a take profit, it's because we've seen the price move to a level where the risk-reward is in our favor. And we never, ever trade in isolation. Gold is just one piece of the puzzle. We diversify. Our gold position is always balanced with other assets, stocks, bonds, real estate. So if one market goes against us, gold can smooth out the volatility. Let's talk about the psychology of institutional trading. The number one rule is patience. We don't chase short-term profits. Markets move in cycles, and we're in it for the long haul. When we take a position in gold, we're not concerned about minute-to-minute price changes. We're focused on the bigger picture, the macro trends that play out over weeks, months, or even years. While many retail traders panic during volatile markets, we stay calm, cool, and collected. Our decisions are based on data, not emotions. And that's the difference between us and the average trader. One more thing, we're always learning. The markets don't stay the same. We review our trades, adapt our strategies, and ensure that we're constantly ahead of the curve. So, if you want to trade gold like an institutional investor, it's all about strategy, precision, and discipline. Master your technical analysis. Understand the macro forces at play. Control your risk. And most importantly, have the patience to let the markets come to you. That's how we do it at the institutional level. If you want to learn more about the strategies and insights that separate the pros from the amateurs, subscribe to the Majestic Trader. Let me know your thoughts in the comments. What do you want to learn next? And remember, trading is about strategy, discipline, and execution.